On today's show, three questions. Number one, how could the Supreme Court influence the economy? Number two, is cash the real risk in your portfolio? And number three, are you keeping up with the trends in dentistry?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are. Sorry, Michelle. It's just Rabih and I today. I also have another apology for Michelle because we're going to start off with some Whoop news, Rabih. Some news on the Whoop.
This is exciting.
It's not. It broke. It broke.
What?
Yes.
How did it break?
So I guess these are all connected, right? If you guys don't know Michelle, she's behind. She's the one who makes all the magic happen as far as producing and editing, along with Becky and Studi. We truly do love Michelle. She's amazing. But the reason why we are just Rabih and I together is because everyone is traveling this week. This weekend just happened to be this convergence of like every event going in the country apparently is going on right now. And so we're spread across the country. I'm actually up in Stevenson, Washington. Incredible, Rabih. We are I'm have ideas already of doing like a team offsite up here. It's amazing up here. So up here with Best for Dentistry with this group, and they're great. But while I was getting ready to get on the plane, and I go to put my backpack on, and I like put it on one shoulder, and then reach up with my other arm. I'm just a big bull in a china shop, and I go to get my other arm in, and it gets caught on my Whoop, and I like force it and kind of push my arm through, and it rips it off, breaks the whole thing. It breaks the clip. And ironically, shout out Cynthia, you know who you are. She is the one, my client, Cynthia, who I was the one who finally convinced me to buy the Whoop. I was literally on the phone with her. I'm not kidding you. I'm on the phone with her talking about some stuff with their situation. And I'm like, Cynthia, my Whoop just broke. And she was like, oh my God. Anyway, it was very dramatic. Tears were shed.
Yeah.
So yeah, there's the update. My Whoop is broken. I need to figure out how to fix it when I get home.
Probably replace it for you.
Well, I have another band that I think has the clip, I think. So when I get home, we'll see if we figure it out.
This part?
Yeah, it broke. So, there you go, Michelle. It's just Rabih and I, and this is my second wearable fitness technology, Rabih, that I broken within like the first 90 days of having it. So maybe it's a me problem. It could be a me problem. Okay, so again, I'm up in Washington. Rabih is back in Utah. We hopefully this goes well because Wi-Fi is spotty up here. So we're going to power through. Rabih, number one, how could the Supreme Court influence the economy?
Yes, this is not a pressing issue or noise in per se, right? But this is more of like, here's what I've been thinking about given how markets have been moving. So I think we mentioned it last week that gold appreciated like 7% in over a 10-day period, right? Which is not usually something we see. And if we look at it actually year to date, what would you guess is the gold performance year to date off the top of your head?
I know it's performed well.
Yep.
It's got to be like 20%, 25%.
Okay, so actually before that spike, gold was 27% year to date. But now after that spike, going until today, we're up 38.6% year to date.
Ooh, okay.
Which is, a lot. And the second in line is actually developed markets with 26. So almost 12 points difference. And then emerging markets with 24. So gold, developed markets, emerging markets in that order. So gold has really run up, and most of the run up that has happened lately was based on the news that the Supreme Court, because now the case has reached the Supreme Court, will have to make a decision whether the tariffs imposed by the president were constitutional or not. Right? The idea, I think the gold is moving on the speculation that the government may have to pay back the money that they earned from the tariffs, like the revenue that was generated from the tariffs. But and that's fine, the money is going to move out, the prices are going to reflect the new reality. But what I'm thinking of from this perspective is much broader. Like, we have to zoom out and think of the relationship of the US economy with respect to other economies around the world, right? If the Supreme Court deems that imposing tariffs in this manner through, a presidential executive order are unconstitutional, this is one less tool for the government to raise money, right? This is where the conversation starts. If we want to just give some background information to understand how we got here, we can simplify it by saying that the US is the main customer of the world. They buy from everyone else. And when you're someone who buys rather than sells, aka we import more than we export, we run something called a current account deficit, aka we are bringing so many more products into the US rather than we're giving out.
Money's going out, goods coming in.
Exactly. More goods in and more money out. So in that situation, a lot of the rest of the world is accumulating US dollars. And if you look at it from a monetary perspective, it means money is leaving the US and it's staying elsewhere, but it's not able to come back. You're not able to, if you just look at the cycle of the money, it's half a cycle. It's just money leaving the US and going outside. And instead of, in the best case scenario, having the US produce products that are so well wanted more than what the Americans buy, kind of balance that circle, to now have the money flow back into the US. Unfortunately, it's not flowing back at the same rate. In economic terms, if this was, just as is, this is the situation, money's flowing out, it's not coming back in, the economy fixes it. What happens is that the US dollar depreciates in value, so imports are not that, high in their magnitude and in their quantity, and that relationship balances out. So there's now a full cycle of the money moving rather than half the cycle. I don't know if you guys are still with me, but the idea is that the economy on its own, the economy on its own has a self-correcting mechanism, which is the currency will depreciate. The US dollar will depreciate if you just keep on importing without exporting, and it will balance the money that is distributed around the world. But this hasn't happened.
I sense a but coming.
Yes. This but, big caps lock but.
I could feel it, yeah.
I can feel the but. This did not work. And why do you think so?
I'm going to guess tariffs.
No, before we get to tariff, very close.
Okay,
it's on the same path. This didn't happen is because instead of letting the economy correct the dysfunction that's happening and create a new equilibrium by devaluing the currency, we decided to just start borrowing as a government and going into budget deficits. And those budget deficits, what they did, they kind of prevented the US dollar from getting devalued naturally due to economic forces. So what has now happened is that not only is money flowing out because we're spending it out of our pocket and there's no money coming in, but we're also preventing the economy, the global economic machine in a sense, from correcting itself because we're just borrowing from future generations to keep pumping money into that outflow pipe without focusing on the inflow pipe. Right? Now, this is the status quo that we are in. The government is trying to find solutions, right? You've got more money coming out than money coming in. You have two possible paths at this point, right? You could either figure out a way to keep creating money internally so they can go out, which means solve the debt problem or put us on a more sustainable path, or figure out a different way where now you can bring money in. And what have we doing to bring money in? This is what you said. Tariffs.
I knew the answer was there somewhere. It was answer to question number 2, not question number 1.
100%.
I forgot my syllabus. Yeah.
100%. So the idea is more money going out, that money coming in. There are 2 ways to fix it. You either figure out to bring money in, or you figure out a better way to allow the money to go out without it harming you. Those are the 2 sides of the equation. So far, and let's not focus on how you fix it in. How do you bring money from outside? The US has been kind of doing 3 things I would think of. 1, imposing tariffs, which this is new, but getting more attention due to this administration. 2, encouraging foreign direct investing, which is also something this administration is doubling down on. You see them going across the world trying to make deals, coming back with, this country decided to invest this amount of money in the US. This country decided to create a joint partnership with these corporations, etc., outside the US, right? So just bringing in investments, not only from countries, but also from companies. Like that last meeting that happened between the president and the tech executives, right? They were sitting on the table and he was asking every single CEO, how much will your country be investing in the US? Because a company could invest anywhere in the world, but them choosing to build those data centers in the US is a foreign direct investment into the US, bringing money in. This is trying to complete the circle. And the last one, which is more geopolitical in the sense, the US kind of has a monopoly on world security to a certain extent, and they bring money in by making those military deals with the rest of the world, because not every single country has the technological ability to create an army. So they just outsource it to the best military producer out there, aka us, right? And they will bring money in through the channel of selling them arms. So just to zoom back out, because we went down a rabbit hole, the whole premise was more money going out than money coming in. Two ways to solve it. Either you fix how they're going out, or you make sure more is coming in. And what we discussed right now is, how do you make sure more is coming in? And the answers were tariffs, foreign direct investments, military, or, selling security. You're selling security as in like defense and security. Those are the three. If the Supreme Court decides to cut away or terminate one of these inflow sources, which is tariffs, then the US has to probably double down on the other two, right? If they do not want to solve the problem internally. The other two that they're going to double down on is foreign direct investments or selling arms, which could just means that there's less development in the rest of the world because more money they are choosing to invest in the US, whether it's by force or due to sanctions or, under threats. Or, unfortunately, we'll start seeing proxy wars popping up left and right just because there needs to be a market for them to sell. That is the outflow. Before we go into the inflow, do you have any comments? I went on a rant.
No, this
here.
is you what?
I went on a rant.
No, this is great. I think it's super helpful. This is why I love doing this with you. And we were talking about this a little bit before, and I think it just gives people hopefully solid, like, kind of big picture perspective. That, to me, the answer, at least the long-term answer, is what you said, the very first thing, which is, can we solve the problem? It sounds like that we created, meaning we as the government. Can we just focus our energy on solving that problem? Like,
great segue, because how do we solve it internally?
Look at that.
Like, right?
Yeah.
If we're fine with the fact that money is going to keep outflowing, and we're not really going to double down on those three sources that brings the money back, we just want to focus on making this outflow more sustainable and just try to give us a lifeline.
Well, just for a second, one sec, Rabih. So, because if we're talking about trying to stop the outflow and equal that out, because that's an option too as well, right? Like, just equal that, like you said, tariffs are a way to do it. But I think the reasons behind the tariffs, at least that the current administration has highlighted, is like, for example, bringing manufacturing back to the U.S. Well, first of all, that doesn't happen like overnight. Like, let's be honest. I think an underlying aspect or tension here is that we have a lame duck president. So I think the things that he's highlighting, like when you talk about the two items that you just mentioned, or I guess there's three, but the Supreme Court might take out one of them, but let's just say it's all three. Those to me are all kind of short term. They truly are short term. When Trump's out of office, which we know because he's a lame duck president, we know exactly when that's going to be. We have no clue who's going to take over afterwards. To me, all signs point to we got to get on board with fixing it internally.
Fixing it internally, just like you have three branches for fixing the external, like providing external inflows. Internally, there are three, but the US has been only focusing on one. And I'm not saying something new here. I'm just trying to build the framework for all of us to think through it. The three ones are either keep on accumulating debt, because that is going to provide you with the outflow, and what the US has been doing for the last 50 years.
Yeah.
Increase revenue for the government, or reduce expenses for the government. So you either increase taxes or you lower spending. We tried our attempt with lowering spending with the Doge it did not work as good as we'd like to, honestly. So does this mean that looking forward a couple of years from now, when the financial situation of the US becomes even harder, just because debt is accumulating, deficits are happening year after year, and our options are exhausted, aka tariffs might be blocked by the Supreme Court, companies might not be interested in doing foreign direct investments into the US, and probably we're in a better world where there's more peace and it's not as easy to fabricate wars,
Would
right?
love that one. Would love that one. Yeah.
Would love that one. But if those are exhausted and we can't do any more debt and we're not able to figure out efficiency because Congress is not able to lower the expenses, they can't agree to lower expenses in a sense, what are we left with? There were 6 options and we only have one, which is the elephant in the room. Can we expect higher taxes coming forward?
Yeah.
How bad will that be? How will that change, the rhetoric of one party winning over another? Increasing taxes does not have to be a losing ticket for one side over another. The Republicans could run on fiscal austerity and, probably push for taxes in a more efficient way. And with taxes, it's interesting because it's not just, we're going to put taxes, and this is where it gets political. You have to answer 3 questions. How much? On who, which is the bigger question politically, and what for? Like, are we going to do taxes for them to be wasted, or are we going to do taxes that actually end up to something? Probably, hopefully, the public opinion shifts where the answer of these 3 questions politically becomes easier for one party, or hopefully both, that they could run on a campaign that says, yes, taxes to get us out of this mess that we're heading towards, and people would follow through. But given this framework, the sources of inflow, the 3 from outside, and the sources of outflow that could be restructured and made better from inside, given these, and if I want to zoom out and think of it as a portfolio manager, just to like tie this knot, because this is what I've been thinking of. What does this tell us about investments going forward? We could expect higher taxes going forward at a higher probability than we used to think. And if that doesn't happen, then the market will have to fix it for us. And that means higher interest rates or the devaluation of the US currency. Doesn't have to be, it'll be inflationary for US consumers, but it doesn't have to be inflationary across the whole world. So you could move your money outside the US if there's an inflation. But I'm trying here to be a little bit stoic, if you can get the connection, and see, like, in the worst case scenario, what are the options that are left if you want to allocate money here and there? And given that circumstances that pan out, you're not trying to predict which asset class does better, but you're trying to figure out which diversified basket wins more points over another diversified basket. Heavy, I know, but I've been thinking about this for like 3 days, and it's like, I'm just going to share it on the podcast.
You're like, I'm just going to unload. No, I mean, again, I love this, Rabih. I love that we're giving people this high level overview. Again, I can't help but think we always teeter on the edge of like, we do not want to make this at all political or take sides here, but we can speak to the politics aspect of it, which is when I think of when you're going through that is until we have a narrative, until we have a philosophical shift in the country and a true coalescence around priorities and believing and understanding that the number one priority above everything at this point for everybody should be fiscal responsibility at the government level and making actual attempts to and like coming together and actually trying to fix that. Until we have someone who is able to convince people of that and shift the narrative and like the belief system and not just keep kicking the can down the road, because I can say this very safely with all confidence because the data is there. Both sides, 100%. It is like basically the same thing since the turn of the century. Like it has been, I don't give a crap who's in office. Both sides are spending and the next one spends more than the other one. And it just keeps happening. So until we have a complete philosophical and like narrative shift and an actual like people again coming together being like, this is number one above everything else. Until that happens, I think we're just going to keep doing the other side of the ledger, which is just kicking the can, doing short-term band-aids, political rhetoric to win your base, make sure the proper lobbyists are in your pocket and keep moving. And I don't know what changes it, I guess I'll say. Maybe not to be like cynical. You're trying to be stoic and I'm sitting here being the cynical guy. But we know we know the answer, and I think that's what's maybe so frustrating is like it's like with the kid, it's like the parents who all know that phones are rotting their kids' brains and social media is rotting all of our brains, and yet we all still stay on it. It's just, I feel like it's kind of the same thing when it comes to this. We all know the problem, but no one's willing to actually step up and say like, no, we got to go fix this. You go on a rant, I go on a rant. Here we go. Here we go. Okay. Are we going to end on a rant? I think we need to end on something more positive on this
I
segment.
am positive because right now we are ranting from a position of strength where no pain is being felt. But at some point, pain will be felt, whether it was through higher taxes because you're obliged to have them, or through loss of purchasing power because inflation is creeping up, not because like you're imposing tariffs. Inflation is going to creep up because you do not have enough money to spend and keep on importing type of thing. The US dollar will devalue. And at that point, hopefully, we are, out of all the other countries in the world, we are the most prepared to turn that struggle into an opportunity because we've got a democratic system. And then, that pain will translate to better people in government. This is my optimistic take on it.
I like that.
Yep.
I like that. I'd like to believe that. I think I want to have hope, I guess I'll say. I'm with you. I want to be optimistic. I think is it fair to say, and maybe all this will get cut because we're getting too political, but I actually think the egg here of the chicken or the egg is for us to actually start moving forward, fixing it internally. We've got to somehow solve the political divide and like start working together in Washington and then have that trickle out. Like, I think that is actually the answer for real. Somehow we've got it. Cause again, I until we do that, until we have like a James Garfield, like, let's bring everyone together and like work with people from both the sides of the administration. Like, until we have something like that, I don't know how this gets fixed. So, but I have hope. I'm with you, Rabih. I have hope that we're going to get there. Okay. Number 2 is cash the real risk in your portfolio. Rabih, you were like pumped about this. You were like, saw my question. You're like, oh, what is this?
Yeah,
What do you
I
think it
did
is?
not read through the lines. I just saw the question. I couldn't read through the lines. My educated guess would be loss of purchasing power because cash loses to inflation. And if you're holding too much cash, that will hurt. This is where you could go through it, but you could go through all other ways, other
Yeah,
places.
no, I think this. So I just think this is a good. I saw an article, Ben Carlson. We referenced him before. A Wealth of Common Sense, great blog. They do, him and his team, they do great work. I saw an article he posted about cash, and this applies really well to things that we see with dentists. I think one of the top risks or one of the top issues we see with a lot of dentists we work with, and just dentists out there in general, is holding too much cash. So I actually thought this was just a good opportunity for us to kind of bring this back. We've talked about it before, but just a good reminder of a few things. So number 1, thinking of kind of the two sides of this when it comes to cash, of like investment decision versus like personal finance decision. Like, where is this coming from? And first and foremost, cash should be really a personal finance decision first. So like, why are you holding cash? The answer to that should fit in the bucket of personal finance, like emergency fund for both home and the business. And I tell people this all the time. There's really only 2 reasons to hold cash: emergency fund and upcoming project that's definable in scope and cost and time frame. Like, that's really the only 2 reasons. But I wanted to talk about this on the other side, which is the investment side, because I've hearing this a little bit more lately, Rabih, and I don't know if you are too, of like, and that makes sense. I just think fear has been stoking over the last few years, but I feel it even more lately of like something's coming. I just heard this again on a call the other day of like, oh, my husband said something's coming. As far as like a huge drawdown, I think people forget that this just happened in 2022, like not that long ago. But I just feel like people are worried. And I think part of it is we've seen a really solid run up in the market, especially the last 3 years. So there's this fear. So Ben Carlson talks about holding cash. So first of all, there's a stat here he gave. There's more than $7 trillion currently in money market funds. That's up from $3 trillion before 2020. So we're referencing like the investment part, the investment decision bucket of this, of like holding cash in your investment accounts and the drag that can create. So I wanted to give some numbers to this. Before I do, any initial thoughts on where this is headed or what I've mentioned so far?
I want to hear your numbers first, just to validate what I'm thinking about.
Okay. So he ran some numbers basically in this and pulled some data. And basically, he looked at 100% as he used S&P. I kind of wish we'd start using more Robbie, you could run these numbers, but I just pulled it from this article. He's comparing an S&P 500 100% portfolio. Let's just imagine a brokerage account versus a 90-10. So saying 90% in S&P and 10% in cash, right? And essentially, over a 30-year period, it equates to a 1% average difference in your return. I'm rounding up slightly, but 1%, right? So a 1% difference in your return by holding 10% in cash. Let's assume you've got the personal finance bucket taken care of. This is just you being afraid of the ups and downs of the market. And so you're going to hold a little bit of cash. You are smirking. You've got thoughts.
I'm ready to pounce. Anyway, keep going.
Okay. So I ran some quick numbers and I just said, let's say you're starting out with $0 and we're going to say you're putting away $2,500 a month, $30,000 a year in various accounts, and you're investing that. So I just did a 1% difference. I said, let's say you did that for the next 30 years at 7%, right? That turns into just under $3 million. So 2.9 and some change. Let's say you invest. So let's say that was in a 90-10 portfolio.
Mm-hmm.
Instead, person B decides to do it in the 100% equity portfolio, we'll call it.
Mm-hmm.
That equates to, do you have any guesses of what that would equate to just off the top of your head? The difference over 30
years, like 150K?
$600,000, $3.5 million just from an allocation decision of sitting on too much cash in a portfolio over 30 years. So I just wanted to put some number to this, but Rabih, you're chomping, I can tell. Hit
Yeah, I'm bothered. This is not related to this article specifically.
I just love, yep, I'm bothered.
This is not related to this article specifically, but it's a very noble cause trying to explain the complexity of finance math and try to like package it to the unknowledgeable listener, trying to make it, but it puts them at a bigger fault than not knowing. Because over here, all we're telling people is, here are the two asset classes that you have to invest in, equities and cash, right? And this is the allocation that you are choosing. But this is not enough. 100% not enough. You know what is going to be the most important factor in deciding whether it's going to be 150 or 650 or 100 or 50K difference between them? Is your rebalancing scheme. This is what determines it. And this is why, like, from a practitioner's point of view, who does this day to day, you know, I'm going to be modest and say, as an investment professional speaking, a lot goes into it. And those two factors, while important, if you're looking at the difference between those two portfolios, the most important factor isn't what you chose, like the allocation that you chose between them, but the rebalancing scheme that you use between them. So when we try to, I would say, reduce this whole complex math into an article so, you know, the reader just reads it and try to replicate it, they will hit more walls than if they didn't even open that door on themselves. So, dude, but I wish I could just write an article with all the different formulas and every single detail so people are on page with me 100%, but this also will work. People will be bored. But the idea is, we're not seeing the big picture with this article. This is why I'm bothered.
Yeah, we're getting riled up today. We are getting riled up on this Friday. We should be happier, Rabih. Football season's going. The weather's great. No, I hear what you're saying. I would say, to me, there's somewhere in the middle, because I think part of the role, I'll just say candidly, part of the role I play on this show specifically is trying to translate your genius brain to the masses, right? And the reason I bring that up is I know where you're coming from. I totally hear what you're saying. I think there's still merit in these types of conversations and this type of article or these types of like notions to raise, because it's more of a directional. I think it's more of an opportunity to talk to the theoretical or like the directional aspect of, I think, giving people. So I'll say this: if you ask most people, then just the normal person, not genius Rabih, who doesn't do this every day, the normal dentist who generally understands how the stock market works, of just like, you know, what they see on TV or whatever. I think majority of dentists that you asked about risk, if you said, you just ask them to define risk or talk about risk of investing, and you said, Is the stock market riskier or is cash riskier?
Hmm.
9 out of 10 dentists are going to say the stock market. So, because they're thinking about the ups and downs and the volatility and things, what the media tells you is risky. The reason I like this type of conversation is to try to give people again, at least just high level directional understanding of the other side of that coin, that over a period of time, cash is actually far riskier than investing in growth assets because it's the only way, pretty much, that you're guaranteeing a loss. And there's true loss of capital, which is really the only risk you should care about when it comes to investing. So it's more of just a mindset shift rather than saying, we're going to basically be able to apply all the technical aspects of this and help you fix this problem. It's more of a philosophical or mindset shift.
No, I agree.
Are
I
you
think
less bothered by that or no?
I am less bothered because
Okay.
the example we went through is probably not the proper one to give the lesson. And the lesson is risk is not only the change in the price, but also how it survives across time. So there are two faces to risk. And when you include time, cash is more risky than stocks. Over a 30-year period, cash is going to underperform stocks. This is the lesson. But dude, creating two portfolios with not specifying the rebalancing, big no. I want to be Oprah and hand people PhDs. I want them to know the difference.
Fine. Rabih, you don't have to like my example, okay, that I stole from someone else. That's fine. No, I think we're saying the same thing. We totally agree. I think, again, if we're applying this just to the mindset of the philosophy, I'm always trying to get dentists to just think about risk in a different way and think that, like, yeah, all that cash sitting in your checking account makes you feel all warm and fuzzy inside when you see it, but is an invisible killer of your wealth if you're not thinking about it properly and you're not thinking about it from this side of, again, I'm with you. It's reductive. It's very simple, but just hopefully getting the idea across that it's a true risk to your portfolio by not being more intentional with your cash. So next time I'll bring a better example. I promise.
No, it's not your fault. It's really not your fault.
We blame Ben Carlson. No, I'm just kidding. Okay. Any other comments on that at all?
No, I could go on a whim and explain all the different rebalancing schemes, but we'll leave that to another episode.
Another show. Okay. Final question. Are you keeping up with the trends in dentistry? I actually wanted to take an opportunity here just to give a shout out to Best in Dentistry, the event that I'm at right now. Walt and Chad and his team, they're fantastic. They're doing amazing things up here in Washington and really all over the country for dentists. But Walt kicked us off. So he's the co-founder of Best for Dentistry. And he posted something I have on my phone right here. So I'm going to look at my picture here, if that's okay. So he posted something, the changing demographics in dentistry. And I sent it to our content team. And I was like, we really just need to talk about this. And we're going to be doing more, I think, more on this. But one slide in particular that caught me was a couple of stats that I thought was interesting. And I want to get your thoughts, Rabih. As of 2023, the graduating class, 55% of the class was female. If we look at active dentists 65 or older as of 2024, 85% male, 15% female. The graduating class of 2023, 55% female, 45% male. That alone to me is just shocking. Of just whenever you see like that big of a shift in demographics, I was just like, wow, that's pretty incredible. 57% of income of the income 2023 class was incoming class was female. So 55% graduating in 2023 was female. 57% of the incoming class was female.
Mhm.
Almost 50% of the 2023 graduating class was non-white, and the workforce is projected to be younger in 2028 than it was in 2024. So anyway, I just thought it was an interesting, probably topic to talk about. Is the main thing being, again, I'm saying, are you keeping up with trends? Are you actually, let's say as a practice owner out there, thinking about the demographic shifts that are out there? And this is just one of the things that's shifting when it comes to age and gender and the demographic shifts. It's a pretty stark contrast. There's going to be ripple effects and things that you're going to want to be aware of that. But I want to get your thoughts, Rabih, of just the trend here and dentists needing to keep up on this.
I think that's all healthy, good signs because the statistic that caught my attention most is that the average dentist, like the age, is going to be lower 4 years from now than it is, just tells you that this is not going to be a dying profession. More people are going after it, and there's more growth there. So from a business perspective, from a dentist, now you can rest assured that by the time you're going to retire, the industry is going to be booming. It's not going to be a doomsday where you're forced to sell to someone you don't want to sell to.
Love that angle, and I've got stats on that. They actually also posted this. So as of 2023, the overall dental business or health, dental services market, $192.2 billion total value. By 2020 or 2030, they're projecting it to be $242 billion. So that backs up what you just said, which is still a growing market, younger people coming in. There's obviously a lot of still issues that need to be addressed in regards to, elephant in the room, student loans, what's going to happen there. There's still issues, obviously, DSOs, private equity. But I love the angle that you just took. And we're gonna bring this full circle. Rabih being positive after some rants in between here by both of us. I really do think we should end this and wrap this up with a belief that we have that dentistry is still an incredible industry and profession and something to be pursued if you're doing it for the right reasons. I don't think it's going anywhere. And specifically, private practice isn't going anywhere. But the reason I wanted to bring this up, just generally speaking, is there's changes happening in not only with private equity, so we all know that, but there's demographic changes happening as well. And I think it's important to be up on those trends and those changes of how you're recruiting, how you're marketing, like what's your business strategy? Like those demographic shifts are important for you to be aware of and how you're changing your strategy overall. Final thought to Rabih.
No, mic drop. What you said was amazing.
That was mic drop? Okay.
Yeah.
I'll take it. Okay. Well, if you're still listening, if you're still at this point, we're very grateful and thankful for that. We're grateful the Wi-Fi held up, Rabih. That was amazing.
True.
If you're still listening, we really appreciate it. You're one of the cool ones. Rabih, thank you for being here. If you want to talk to us, well, actually, I'll back up. If this episode was helpful, it was fun in some way, valuable in any way, educational anyway, and there's a dentist out there you think should listen, please, if you want to hear Rabih or Matt's rants, or you think someone needs to hear that, please go ahead.
I need to make a disclaimer here, just saying. I said this is what I'm thinking of. The idea is, and especially when you're managing money, I think you have to imagine worst case scenarios and see how you are prepared for those, just out of your responsibility of managing other people's money. This does not reflect that I am panicking or I think the world is going to end.
Yeah.
On the contrary, the US is still in a great position, has lots of leveraging powers and tools. We still live in a democracy. The economy is at an all-time high and everyone is doing really well. And industry, just for the last topic, dentistry is a great industry that's growing and continuing on growing. So those are all good signs. Just you have to do the exercise of going into worst case scenarios and see how you are going to work in case they happen, just because this is our responsibility to you, listeners, to, we're here
Rabih
to help you through all the situations.
Rabih and I are feeling
I feel like I ruined people's weekends.
Rabih and I are feeling insecure about our rants, but I think that was the mic drop. So again, if this is helpful in any way, and you think there's a dentist out there that needs to hear it, that would be valuable or fun for them to hear, we'd really appreciate you share the episode. Everything we do, truly, and we try to have fun with it, but above all, we want to add value to the dental space, provide education, hopefully different perspective, and truly, all jokes aside, really be a positive force in the dental space. So if you feel someone needs to hear this, please share it. If you want to talk to us, dentistadvisors.com. You can click on the yellow book free consultation button. We'd love to talk to you, hear your story, see how we can help you in your life with anything to do with investing, financial planning, accounting. We'd love to talk to you. For now, Rabih, thanks for sharing your wisdom. Everyone, thank you so much for listening. That was our 2 cents. Till next time, have a good weekend. Bye-bye.